Thanks, Tom. So, gentlemen, we'll start with the bad news going on the last panel. Your markets are going to crap. The good news is it hasn't happened yet, so you've got time to move. It's been an interesting year for global equities. We've had the haves and have-nots. We've seen the Dow up circa 18%, the Nasdaq up 25%. It's streaking the field. The Europeans, we should mention New Zealand. New Zealand's up over 20%. It's had a terrific couple of years, let alone last year. And then the have-nots, Australia fits into that category, unfortunately, along with the Europeans, and they've moved in low single digits. So it's been everyone's positive, so it's been good, but it's been a mixed market, and particularly at the end of, I think the US now is up circa 230% since the bottom in March 2009, and the poor old Nasdaq, it's clocked up 564%. So it's had a nice time of it. Paul, we'll start with you. Given the environment that we've had, which has been bullish for a long time now, and in the US, it seems like the bullishness is accelerating. How has your portfolio changed over the last 12 months, and where's it sit now? Because your portfolio normally tells you how you're thinking.
Yeah, I guess the main change is that we've reduced our invested position. If you go back 7 or 8 years ago, the risk reward was so compelling that you wanted to be at the maximum risk reward, whatever you're willing to tolerate. But as you've shown, markets have done well, and so the risk reward has changed. It's more a 50-50 proposition now. Got to be very selective, and so whatever your tolerance level was, it should be reduced. So, we're pretty much top slice, sold out of a few areas, but basically reduced our gross invested position by about 20%.
Right, and you're a bit unusual to everyone else that you can invest in debt products as well. We've heard from the last panel that they're really concerned about debt markets globally, given what's happened. So what have you done in that area?
We've sold our entire credit position, which we invested in back in 2009, because credit spreads they're more than normalised. The reality is they're probably a bit of an anomaly themselves. So that's totally gone out of the portfolio. Our view is that long-term interest rates have inflected, and as a result of that, you want to be very wary of anyone or any investment that's been the beneficiary of that 30-year downtrend in interest rates.
Okay, we'll come back to that in a minute. Peter, you cut your teeth domestically, and you've taken your skills globally. And we've just heard from Paul, and we've heard from the previous panel. If we come out of the helicopter and go down to the coalface, how do you navigate your way around in this kind of market? Rising interest rates, it feels like there's pressure, and one day it's going to snap. Volatility has increased. So from an equity point of view, how do you position yourself going forward?
Matthew, we just track 200 to 300 companies around the world and allocate capital, push capital to companies where we see risk-adjusted value latencies. Just before I answer your question directly, I just want to give you a couple of quick stats. Australia, number one market in 120 years, total return roughly 9%, 7% real, and that's number one, beats all countries around the world. We think that, and it's been very interesting watching the maturing of the Australian market, and has really made us excited about the global equities. In terms of the things that we look for to mitigate risks, and definitely...
And you agree with Paul on the risks that are out there?
Yeah, definitely. Sort of easy money cycle, and in terms of the positioning around what we call bond-like equities that sit in the portfolios, we're down to one stock, so we've just broadly reduced that over the last couple of years. But I think there's lots of opportunities in spaces where industries are transforming and need what we call low risk turnaround opportunities, and in finding companies with governance structures and operator management teams that are very cognizant of the risks. And what we really love about these, if you like, family-orientated, family-linked companies and companies with ownership cultures